Introduction to real estate tax. Real estate investment offers significant wealth-building potential, but understanding its unique tax landscape is crucial for maximizing returns. Unlike other asset classes, real estate benefits from specific tax codes designed to encourage investment and development. These tax advantages, when properly utilized, can significantly reduce an investor's taxable income and increase their net cash flow. Navigating these complexities requires a strategic approach, blending financial acumen with a solid grasp of tax regulations. This course will demystify these strategies, providing actionable insights for both novice and experienced investors. It emphasizes the importance of proactive tax planning from the initial acquisition through to the eventual disposition of a property. Understanding the foundational principles of real estate taxation sets the stage for more advanced strategies. Effective tax planning begins with recognizing that every real estate transaction has tax implications, from property acquisition to rental income and eventual sale. Ignoring these implications can lead to missed opportunities for tax savings and potentially higher tax burdens. Investors must consider the timing of their investments, the structure of their ownership, and the nature of their income and expenses. Proactive engagement with tax strategies allows investors to legally minimize their tax obligations, thereby enhancing the overall profitability of their real estate portfolio. This introductory module lays the groundwork for understanding how various tax rules apply to different aspects of real estate investment, highlighting the importance of a comprehensive approach. Understanding taxable income in real estate. Taxable income in real estate is not simply the gross rent collected. It involves a nuanced calculation that considers various deductions and expenses. Investors must accurately track all income streams, including rental payments, laundry income, and other property-related revenues. Simultaneously, they need to account for all allowable expenses, which directly reduce their gross income, to arrive at a net taxable figure. This net figure is then subject to applicable tax rates, determining the investor's ultimate tax liability. Understanding the distinction between gross and net income is fundamental for effective tax planning. Proper record keeping is paramount to substantiate all income and expense claims, preventing potential issues with tax authorities. This section clarifies what constitutes taxable income and how it is calculated for real estate investors. Key components of real estate taxable income include gross rental income, which is the total amount received from tenants before any deductions. However, this gross amount is significantly reduced by various operating expenses such as property taxes, insurance, maintenance, and utilities. Furthermore, non-cash deductions like depreciation play a crucial role in lowering taxable income, often allowing investors to show a paper loss even when the property is generating positive cash flow. Interest paid on mortgages is another substantial deduction that can dramatically impact the taxable income calculation. Investors must also consider capital gains when a property is sold, which are treated differently from ordinary income. Accurately categorizing these income and expense items is essential for precise tax reporting and strategic planning. Key tax entities for investors. Choosing the right legal entity for real estate investments is a critical decision with significant tax implications. Different entity structures offer varying levels of liability protection, administrative burden, and tax treatment. For instance, owning property as a sole proprietorship is simple but provides no personal liability protection, and all income flows directly to the individual's personal tax return. Partnerships allow for shared ownership and responsibilities, but can have complex tax reporting requirements. Limited liability companies, LLCs, are popular due to their balance of liability protection and flexible tax treatment, often allowing pass-through taxation. Corporations, both C Corps and S Corps, also present unique advantages and disadvantages, particularly concerning double taxation or specific income distribution rules. The choice of entity should align with an investor's long-term goals, risk tolerance, and the scale of their real estate operations. Each entity type has distinct tax advantages and disadvantages that investors must carefully weigh. An LLC, for example, can be taxed as a sole proprietorship, partnership, or even a corporation, offering immense flexibility. This choice impacts how income and losses are reported to the IRS and how self-employment taxes are handled. S-corporations can help reduce self-employment taxes for active investors by allowing a portion of income to be distributed as dividends, which are not subject to these taxes. C-corporations, while subject to double taxation, can be beneficial for retaining earnings within the company for future investments or for attracting institutional capital. Understanding these nuances is essential for optimizing tax outcomes and ensuring legal compliance. Consulting with a tax professional is highly recommended to select the most appropriate entity structure for specific investment objectives. Depreciation, a powerful tax shield. Depreciation is a non-cash expense that allows real estate investors to recover the cost of an income-producing property over its useful life. This powerful tax shield reduces taxable income without affecting the property's cash flow, making it a cornerstone of real estate tax strategy. The IRS mandates specific recovery periods for different types of property. For instance, residential rental property is typically depreciated over 27.5 years, while commercial property is depreciated over 39 years. Land is never depreciated because it is not considered to wear out or become obsolete. Understanding how to properly calculate and apply depreciation is essential for minimizing tax liabilities and improving investment returns. It effectively creates a paper loss that can offset real income, even when the property is generating positive cash flow. To calculate depreciation, investors must first determine the property's depreciable basis, which is generally the cost of the building and any improvements, excluding the land value. This basis is then divided by the applicable recovery period to determine the annual depreciation deduction. For example, a residential property with a depreciable basis of $275,000 would yield an annual depreciation deduction of $10,000, $275,000 over 27.5 years. This deduction can significantly reduce an investor's net taxable income, potentially lowering their overall tax burden. Proper documentation of the property's cost basis and land value is crucial for accurate depreciation calculations. Maximizing depreciation deductions is a key strategy for long-term real estate investors, allowing them to defer taxes and retain more capital for future investments. Cost segregation studies. Cost segregation is an advanced tax strategy that accelerates depreciation deductions by reclassifying components of a building from real property to personal property. Instead of depreciating the entire building over 27.5 or 39 years, a cost segregation study identifies assets like carpeting, appliances, electrical systems, and landscaping that can be depreciated over much shorter periods, typically 5, 7, or 15 years. This acceleration of depreciation significantly increases deductions in the early years of ownership, leading to substantial tax savings and improved cash flow. It is particularly beneficial for newly constructed properties, properties acquired recently, or those that have undergone significant renovations. Engaging a qualified professional to conduct a cost segregation study is crucial for accuracy and compliance with IRS guidelines. The process of a cost segregation study involves a detailed engineering analysis of a property, breaking down its construction costs into various components. This analysis requires expertise to correctly identify and categorize assets according to IRS classifications. For example, items like decorative lighting, specialized plumbing, and certain land improvements can often be reclassified. The benefits include not only accelerated depreciation, but also the potential for catch-up depreciation on properties acquired in prior years, allowing investors to claim missed deductions. While there is an upfront cost for the study, the tax savings often far outweigh this expense, making it a highly effective strategy for many real estate investors looking to maximize their tax benefits and improve their investment's financial performance. Section 179 and bonus depreciation are powerful tax incentives that allow real estate investors to deduct the full cost of certain qualifying property in the year it is placed in service, rather than depreciating it over many years. Section 179 primarily applies to tangible personal property used in a trade or business, such as office equipment, machinery, and certain qualified real property improvements like roofs, HVAC, fire protection, and security systems. This immediate expensing can significantly reduce taxable income in the year of purchase, providing a substantial cash flow benefit. There are annual limits to the Section 179 deduction, and it cannot be used to create a net loss for the business. Understanding these limits and qualifying assets is key to leveraging this strategy effectively. Bonus depreciation, often enacted during economic stimulus periods, allows businesses to deduct a large percentage, currently 100% for property placed in service after September 27, 2017, and before January 1, 2023, then phasing down of the cost of eligible, new and used property. Unlike Section 179, bonus depreciation can create a net loss and is not subject to income limitations. It applies to a broader range of assets, including certain qualified improvement property for real estate. Both Section 179 and bonus depreciation are particularly valuable for investors making significant capital expenditures, as they provide immediate tax relief. Combining these strategies with cost segregation can further amplify tax savings, allowing investors to retain more capital for reinvestment and accelerate their wealth accumulation in real estate. Stop. Operating expenses and deductions. Real estate investors can significantly reduce their taxable income by deducting ordinary and necessary operating expenses incurred in managing their properties. These expenses must be directly related to the rental activity and not be considered capital improvements. Common deductible operating expenses include property taxes, insurance premiums, mortgage interest, utilities paid by the landlord, and professional fees for property management, legal, and accounting services. Maintenance and repair costs, such as fixing a leaky faucet or painting a unit, are also generally deductible in the year they are incurred. Keeping meticulous records of all these expenses is paramount for accurate tax reporting and to withstand any potential IRS scrutiny. These deductions directly lower the net rental income, thereby reducing the investor's tax liability. It is crucial to distinguish between deductible repairs and non-deductible capital improvements, as misclassification can lead to tax issues. Repairs maintain the property's current condition and are expensed in the current year, while improvements add value, prolong useful life, or adapt the property to new uses, and must be depreciated over time. Examples of capital improvements include adding a new room, replacing an entire roof, or upgrading a major system like HVAC. Additionally, travel expenses incurred for property management, advertising costs for vacancies, and even home office expenses, if a dedicated space is used exclusively for the real estate business, can be deductible. Understanding the full scope of allowable operating expenses empowers investors to maximize their deductions and optimize their tax position, ultimately enhancing their investment's profitability. Passive activity loss (PAL) rules. The passive activity loss (PAL) rules are a significant consideration for real estate investors, as they limit the ability to deduct losses from passive activities against non-passive income. Generally, real estate rental activities are considered passive activities by the IRS. This means that losses generated from these activities can only be used to offset income from other passive activities, not active income like wages or portfolio income like stock dividends. This limitation is designed to prevent investors from using real estate losses to shelter other forms of income. Understanding these rules is crucial for accurately reporting losses and avoiding potential tax penalties. The PAL rules can significantly impact an investor's ability to benefit from depreciation and other deductions in the short term. There are, however, important exceptions and nuances to the PAL rules that can allow investors to deduct passive losses. One major exception is for real estate professionals, who can deduct passive losses against active income if they meet specific material participation tests. These tests typically involve spending a significant number of hours, e.g., more than 750 hours annually, in real estate trades or businesses in which they materially participate, and more than half of their personal services in all trades or businesses are performed in real property trades or businesses. Another exception is the active participation rule, which allows individuals to deduct up to $25,000 of passive losses from rental real estate if they actively participate in the management of the property and their adjusted gross income is below certain thresholds. Navigating these exceptions requires careful tracking of time and activities, and often professional guidance. Capital gains tax basics. Capital gains tax applies to the profit realized from the sale of an asset, such as real estate, that has been held for investment purposes. The tax rate depends on how long the asset was held. Short-term capital gains, derived from assets held for 1 year or less, are taxed at ordinary income tax rates, which can be significantly higher. Long-term capital gains, from assets held for more than 1 year, are generally taxed at more favorable rates, 0%, 15%, or 20% for most taxpayers, depending on their income bracket. Understanding this distinction is crucial for real estate investors, as holding a property for just over a year can dramatically reduce the tax burden upon sale. Strategic timing of property dispositions is therefore a key component of capital gains tax planning. Calculating capital gains involves subtracting the property's adjusted basis from its selling price. The adjusted basis includes the original purchase price plus the cost of any capital improvements, minus any depreciation deductions taken over the years. This depreciation recapture can complicate the calculation, as a portion of the gain attributable to depreciation may be taxed at a higher rate, up to 25% for unrecaptured Section 1250 gain. Additionally, high-income taxpayers may be subject to the net investment income tax (NIIT) of 3.8% on certain net investment income, including capital gains. Investors must also consider state-level capital gains taxes, which vary widely. Thorough record-keeping of all acquisition costs, improvement expenses, and depreciation taken is essential for accurately determining the adjusted basis and minimizing capital gains tax liability. Section 1031 Like-Kind Exchanges. Section 1031 of the Internal Revenue Code allows real estate investors to defer capital gains taxes when they exchange one investment property for another like-kind property. This powerful strategy enables investors to reinvest all of their sale proceeds, including the portion that would have been paid in taxes, into a new property, thereby increasing their purchasing power and accelerating portfolio growth. The like-kind requirement is broad, meaning any real property held for productive use in a trade or business or for investment can be exchanged for any other real property held for productive use in a trade or business or for investment. For example, an apartment building can be exchanged for raw land or a retail property for an office building. This deferral is not a forgiveness of taxes, but rather a postponement until the replacement property is eventually sold without another 1031 exchange. To qualify for a 1031 exchange, strict timelines and rules must be followed. The investor must identify potential replacement properties within 45 days of selling the relinquished property, and must close on the replacement property within 180 days of the sale. A qualified intermediary (QI) is required to facilitate the exchange, holding the sale proceeds to prevent the investor from having constructive receipt of the funds, which would trigger immediate taxation. The value of the replacement property must be equal to or greater than the relinquished property, and all equity and debt must be replaced to avoid boot, taxable cash or other property received. Understanding these intricate rules and working with experienced professionals are critical for successfully executing a 1031 exchange and maximizing its tax deferral benefits, allowing investors to continuously grow their real estate wealth without immediate tax erosion. Opportunity Zones. Opportunity Zones are a federal program designed to spur economic development and job creation in distressed communities by providing tax incentives to investors. Investors can defer or even eliminate capital gains taxes by reinvesting their gains into qualified opportunity funds, QOFs, which then invest in designated opportunity zones. This program offers three main tax benefits: deferral of capital gains until 2026 or until the QOF investment is sold, a step-upping basis for the original capital gain, reducing the deferred gain by 10% after 5 years and an additional 5% after 7 years, and permanent exclusion from capital gains tax on the appreciation of the QOF investment if held for at least 10 years. These powerful incentives encourage long-term investment in areas that need it most, aligning social impact with financial gain. To qualify for Opportunity Zone benefits, investors must reinvest eligible capital gains into a QOF within 180 days of the sale of the original asset. The QOF must hold at least 90% of its assets in qualified Opportunity Zone property. This property can include real estate, both new construction and substantial rehabilitation, or businesses operating within the zone. It is important to note that the investment must be equity, not debt. The program is complex, with specific rules regarding what constitutes a qualified Opportunity Zone property and substantial improvement. Investors considering this strategy should consult with tax and legal professionals to ensure compliance and maximize benefits. Opportunity zones represent a unique avenue for real estate investors to achieve significant tax savings while contributing to community revitalization, making them an attractive option for certain long-term investment strategies. Space. Avoiding recapture taxes. Recapture taxes are a critical consideration for real estate investors, primarily related to the depreciation deductions taken over the property's holding period. When a depreciated property is sold for a gain, a portion of that gain, specifically the amount attributable to depreciation, may be subject to a special tax rate. This is known as depreciation recapture. For Section 1250 property, real property, the unrecaptured Section 1250 gain is taxed at a maximum rate of 25%, which is often higher than the long-term capital gains rate. This means that even if an investor qualifies for favorable long-term capital gains rates, a significant portion of their gain could still be taxed at a higher rate due to prior depreciation deductions. Understanding how to mitigate or defer these recapture taxes is essential for maximizing net proceeds from a sale. Several strategies can help investors avoid or defer depreciation recapture taxes. The most common and effective method is a Section 1031 like-kind exchange. By exchanging one investment property for another, investors can defer both capital gains and depreciation recapture taxes indefinitely, as long as they continue to reinvest in like-kind properties. Another strategy involves holding the property for a very long period, allowing the impact of recapture to diminish relative to the overall appreciation. Donating appreciated real estate to a qualified charity can also eliminate capital gains and recapture taxes while providing a charitable deduction. Additionally, proper tax planning, including the timing of sales and understanding the property's adjusted basis, is crucial. Consulting with a tax advisor before a sale is highly recommended to explore all available options and implement the most advantageous strategy to minimize recapture tax liability. Tax implications of mortgage interest. For real estate investors, mortgage interest is one of the largest and most significant deductible expenses, directly reducing taxable income. The interest paid on loans used to acquire, construct, or improve rental properties is fully deductible against the rental income generated by those properties. This deduction significantly lowers the net taxable income from real estate activities, making leverage a powerful tool not just for amplifying returns, but also for reducing tax liabilities. The ability to deduct substantial interest payments is a key advantage of real estate investment compared to other asset classes. Investors must maintain accurate records of all interest payments made throughout the year to ensure proper deduction on their tax returns. This deduction applies to both residential and commercial investment properties. The deductibility of mortgage interest can be particularly impactful in the early years of a loan, when a larger portion of each payment goes towards interest rather than principal. As the loan amortizes, the interest portion decreases and the principal portion increases. It is important to note that interest on personal residences has different deductibility rules than interest on investment properties. For investment properties, the interest is considered a business expense. If an investor has multiple properties, the interest from all qualifying mortgages can be aggregated and deducted. Understanding this major deduction is fundamental for optimizing cash flow and minimizing tax burdens, allowing investors to effectively manage their property portfolios and enhance their overall profitability. This strategy underscores the financial benefits of prudent debt utilization in real estate. Refinancing and cash-out refinance. Refinancing an investment property can have significant tax implications, both positive and negative, that investors must consider. When an investor refinances, they replace an existing mortgage with a new one, often to secure a lower interest rate, change the loan term, or pull out equity. Generally, the proceeds from a refinance are not considered taxable income, as they are treated as loan principal. This allows investors to access their property's equity tax-free, which can then be used for other investments, property improvements, or to pay down other debts. However, the new loan's interest payments will continue to be deductible, providing ongoing tax benefits. Understanding the non-taxable nature of refinance proceeds is a key advantage for real estate investors seeking to optimize their capital structure. A cash-out refinance specifically involves taking out a new mortgage for more than the outstanding balance of the old one, receiving the difference in cash. This cash is typically tax-free at the time of receipt, offering a powerful way to unlock equity without triggering a taxable event. The interest on the new, larger loan remains deductible, provided the funds are used for business or investment purposes related to the property. However, if the cash-out proceeds are used for personal expenses, the deductibility of the interest may be limited. Investors should carefully evaluate the costs associated with refinancing, such as closing costs and appraisal fees, as these can offset some of the benefits. Strategic use of cash-out refinances can provide liquidity for further real estate acquisitions or portfolio expansion, all while maintaining tax efficiency, but requires careful planning and understanding of the rules. Debt forgiveness and tax consequences. When debt is forgiven or cancelled, it can have significant and often unexpected tax consequences for real estate investors. Generally, if a lender forgives or cancels a debt, the amount of the cancelled debt is considered taxable income to the borrower. This is known as cancellation of debt, COD income. For example, if a lender forgives a $50,000 mortgage balance, that $50,000 could be added to the investor's taxable income for the year, potentially leading to a substantial tax bill. This rule applies whether the debt is forgiven in a foreclosure, short sale, or through a direct negotiation with the lender. Understanding this principle is crucial for investors facing financial distress or negotiating debt restructuring, as the tax implications can be severe. However, there are several important exceptions to the code income rule that can exclude or defer the recognition of this income. One common exception is the insolvency exception, which states that if the taxpayer is insolvent, liabilities exceed assets immediately before the debt cancellation, the amount of code income equal to the insolvency is excluded from gross income. Another exception applies to debt discharged in bankruptcy. Additionally, if the cancelled debt is qualified real property business indebtedness, an election can be made to exclude the code income, but the basis of depreciable real property must be reduced by the excluded amount. These exceptions are complex, and require careful analysis of the investor's financial situation. Consulting with a tax professional is essential to determine eligibility for these exclusions and to navigate the intricacies of debt forgiveness tax rules, ensuring investors avoid unforeseen tax liabilities. Using self-directed IRAs for real estate. Self-directed individual retirement accounts (SDIRAs) offer a powerful way for investors to use their retirement savings to invest in alternative assets, including real estate. Unlike traditional IRAs or 401ks that are limited to stocks, bonds, and mutual funds, SDIRAs allow the account holder to direct investments into a much broader range of assets. When real estate is held within an SDIRA, all income and gains generated by the property grow tax-deferred or tax-free in the case of a Roth SDIRA. This means rental income, capital gains from property sales, and other profits are not immediately taxed, allowing the investment to compound more rapidly. This strategy can be particularly attractive for long-term wealth building, as it shelters real estate profits from annual taxation. While SDIRAs offer significant tax advantages, they come with strict IRS rules and regulations that investors must meticulously follow. The most critical rule is the prohibited transaction rule, which prevents the IRA holder and certain disqualified persons, e.g., spouses, lineal descendants, fiduciaries, from engaging in transactions that benefit them personally. This includes self-dealing, such as buying a property from yourself or living in a property owned by your SDIRA. All expenses related to the SDIRA-owned property must be paid from the SDIRA, and all income must flow back into it. Additionally, SDIRAs cannot invest in collectibles or life insurance. Violating these rules can lead to severe penalties, including the disqualification of the IRA. Therefore, while SDIRAs provide a unique opportunity for real estate investment, they require a deep understanding of compliance and often the assistance of a specialized custodian. This strategy is not for the faint of heart, but for those who navigate it correctly, the tax benefits can be substantial. Estate tax planning for real estate. Estate tax planning for real estate is crucial for high net worth investors to ensure their assets are transferred efficiently and with minimal tax burden to their heirs. Without proper planning, a significant portion of a real estate portfolio could be subject to federal estate taxes, which can be as high as 40%, and potentially state estate or inheritance taxes. The federal estate tax exemption amount is substantial, currently over $13 million per individual for 2024. But for those whose assets exceed this, strategic planning becomes imperative. Estate planning involves structuring ownership, utilizing trusts, and making timely gifts to reduce the taxable estate. The goal is to preserve wealth across generations and avoid forced sales of properties to cover tax liabilities. Key strategies in real estate planning include establishing various types of trusts, such as irrevocable life insurance trusts, ILITs, or qualified personal residence trusts, QPRTs, to remove assets from the taxable estate. Gifting real estate during one's lifetime within annual and lifetime exclusion limits can also effectively reduce the size of the taxable estate. Another powerful technique is the use of family limited partnerships, FLPs, or limited liability companies, LLCs, to hold real estate, allowing for valuation discounts on transferred interests due to lack of marketability and control. These entities also provide asset protection and facilitate multi-generational wealth transfer. Understanding the step-up in basis rules at death is also vital, as it can eliminate capital gains tax on appreciated property for heirs. Comprehensive estate planning, often involving legal and tax professionals, is essential to navigate these complex rules and achieve optimal outcomes for real estate wealth transfer. Gifting real estate and tax basis. Gifting real estate can be an effective strategy for estate planning and wealth transfer, but it comes with specific tax implications, particularly concerning the property's tax basis. When real estate is gifted during the donor's lifetime, the recipient, donee, generally receives the property with a carryover basis. This means the donee's basis in the property is the same as the donor's adjusted basis at the time of the gift. If the property has appreciated significantly, the donee will inherit a low basis, potentially leading to a substantial capital gains tax liability when they eventually sell the property. Understanding this carry-over basis rule is critical, as it differs significantly from the step-up in basis rule for inherited property. Careful consideration of the property's current value and the donor's basis is essential before making a gift. In contrast to gifted property, real estate inherited at death typically receives a step-up in basis to its fair market value on the date of the decedent's death. This means that if the property has appreciated, the heirs can sell it shortly after inheritance with little to no capital gains tax liability, as their basis is reset to the current market value. This difference in basis treatment between gifted and inherited property is a crucial factor in estate planning decisions. While gifting can remove assets from a taxable estate, it might shift a capital gains tax burden to the recipient. Donors also need to consider annual gift tax exclusions and lifetime gift tax exemptions. For 2024, the annual exclusion is $18,000 per recipient, allowing tax-free gifts up to that amount. Gifts exceeding this may use up a portion of the lifetime exemption. Strategic planning, often involving a comparison of potential estate tax savings versus future capital gains tax for heirs, is vital to determine the most tax-efficient method of transferring real estate. Advanced tax planning techniques. Beyond the foundational strategies, advanced tax planning techniques offer sophisticated ways for real estate investors to further optimize their tax positions. One such technique involves the use of charitable remainder trusts, CRTs. An investor can transfer an appreciated investment property into a CRT, receive an immediate income tax deduction, and avoid capital gains tax on the sale of the property by the trust. The trust then provides an income stream to the investor for a specified term or for life, with the remainder going to charity. This strategy is particularly appealing for highly appreciated properties, where the investor desires both income and philanthropic impact. CRTs allow for diversification out of a concentrated real estate asset without immediate tax consequences. Another advanced strategy is the use of deferred sales trusts, DSTs. A DST allows an investor to sell an appreciated property and defer capital gains taxes over an extended period. The property is sold to the DST, which then sells it to the ultimate buyer. The investor receives installment payments from the DST, spreading the capital gains tax liability over many years. This can be particularly useful for investors who want to sell a property but are not ready to identify a replacement property for a 1031 exchange, or for those who want to diversify their assets without triggering an immediate tax event. These advanced techniques require careful structuring and compliance with complex IRS rules, making professional guidance indispensable. They represent powerful tools for significant tax deferral and wealth preservation for sophisticated real estate investors. Staying compliant and future trends. Staying compliant with tax laws is paramount for real estate investors to avoid penalties, audits, and legal issues. The tax landscape is constantly evolving, with new legislation, IRS rulings, and court decisions frequently impacting real estate taxation. Investors must proactively stay informed about these changes, either through continuous education or by working closely with qualified tax professionals. Accurate record keeping is the foundation of compliance, requiring meticulous documentation of all income, expenses, depreciation, and transaction details. Filing taxes correctly and on time, utilizing appropriate forms and schedules, is non-negotiable. Non-compliance can lead to significant financial penalties, interest charges, and even criminal charges in severe cases. A proactive and diligent approach to tax compliance is an investment in the long-term success and security of a real estate portfolio. Looking ahead, several future trends could significantly impact real estate tax strategies. Potential changes in capital gains tax rates, adjustments to depreciation schedules, or modifications to like-kind exchange rules are always on the horizon. influenced by political and economic shifts. The increasing focus on environmental sustainability might lead to new tax incentives for green building or disincentives for non-compliant properties. Technological advancements, such as blockchain for property records or AI for tax preparation, could also streamline compliance and open new avenues for analysis. Investors should regularly review their tax strategies with professionals to adapt to these changes, ensuring their plans remain optimal and compliant. Continuous learning and adaptability are key to navigating the dynamic world of real estate taxation and maintaining a competitive edge.